Okay, welcome to the Apex Trades Trading Masterclass. This will be a series of videos that we're going to be going over. It doesn't really matter what level you're at when it comes to trading, whether you're a beginner or even more advanced. Realistically, what this is about is to create a framework, a solid understanding of what the charts are doing, which direction momentum the markets are moving in, and then how we can take advantage. But there's a lot to cover, and so I'm going to be breaking them down into 5 different videos. The first one is predominantly just going to be on market structure basics. It's the foundational layer that we need in order to be able to understand, so that when we come up to the future videos that will be more complex, we'll have that foundational layer down. Okay, so just as a kind of caveat, this is how I like to put my charts up, just because typically you're going to see green or red or whatever it is, but this is the PVSRA, I believe it's called PVSRA. Yeah, it's what it shows you is what we call vector candles. These red and green candles, these are essentially just when there's 3 times or 300% more volume than the previous, I think it's 10 or 20 periods, it's going to give you a different color. And that's usually, when you see these kind of candles, it's usually that there's a lot of players, a lot of tick volume that's stepping into the market, and can sometimes be a good indication that something has changed, right? It's outside of the norm in terms of its tick volume. So what you'll see is these can kind of come into play when it comes to the trading style and trading stance. And so whether you want to have these on or not is entirely up to yourself. But if you're going to follow along with my style, I suggest you add them on. I'll just kind of go over the settings. So this is just called the PVSRA_VS. I set the PVSRA candle colors to tick, and that means it'll override whatever your colors are, because it's kind of like I'm not too much, wanting to see what's going on with the kind of light grey and dark grey. Light grey is an up candle, and dark grey is a down candle. I just want to see when a lot of the volume comes into play. Okay, you can change the colors. I just leave them as default. And so what you tend to see is the green is 300% more times volume, whether that's an up candle. The red is a 300% more tick volume than the previous 10 or 20 candles to the downside. And then you have the blue and these kind of violet pink colors. They are what they call stop and volume candles. So it's like a slowdown of the volume. So, when you start to see the blue, what it should imply is that actually, okay, since we've been starting to push up on higher volume, a blue candle will mean that it's, I think it's 250% more, so it's less volume than the 300% more. So sometimes it can act as an indication that the volume is starting to slow down a bit. Like here, you could see, we've been bearish, a couple of red vector candles have come into play, then we've seen some blue vector candles, which is lessening of volume, and that then started the move back to the upside. So just a good indication of what's going on the charts, and then that's obviously replicated with the volume here. Depending upon what session we're covering, I will go into different indicators that I use, but predominantly we use the Apex screener companion. I'll go into that on a separate video, but for now this is purely a part about my market structure basics. Okay, so let's get into play. So when we talk about market structure, what are we talking about? Predominantly, I want to identify the trend, right? When are we in a trend, and what's that relative position mean when we are in a trend? And so if I take just a simple diagram of an uptrend, I don't want to use that one actually. Uptrend, we get a pullback. Uptrend, we get a pullback. Uptrend, pullback, and you see here we don't make that upward move. In fact, we pull back again, pull back down, and then we start that trend again. Now look, we know markets are never as kind of clear and as concise as this, but I like to kind of at least demonstrate what perfect utopia looks like, because then we need to be able to identify and spot these kind of bigger moves on the longer time frame. And so I use 2 tools. I use the highlighter tool and I use the brush. And now my key is here, right? Which means I trade 2 time frames. I trade the 4 hour and I trade the 15 minute. I'm using the 4 hour to understand my swing range, and I'm using the 15 minute. We can call that an external range, right? The 4 hour, that kind of bigger movement. And we call the 15 minute the internal structure within that 4 hour move. Okay, so I wanted to just highlight that key there. This is going to be what we're going to use to just identify what that move looks like, right? So in a typical move, what can you see? Clearly we can see move to the upside, move to the upside, move to the down upside, and then we start to pull back, and then we start to pull up. Now if this was the 15 minute time frame, on a 4 hour, it might look something like this, right? Take that point there, there's the high. Do that with the path 2. Take the high, take the low, and take the high. Now 2 things kind of spring out to mind here. We've got on the 4 hour, and I'll just do that as a different color. Right, on the 4 hour time frame, it's bullish, right? We go from here to here, we pull back, and then we move to the upside. And so that's, relatively speaking, that's just a move that's bullish. But on the 15 minute, which is the white one, at some point we flip bearish, right? We no longer make moves to the upside, and in fact we split down. We're going to cover multi-time frame analysis in a separate session, but I just wanted to kind of get across the importance of always having a relative position depending upon what your 2 time frames are. Like I trade 2 time frames, 4 hour, 15 minute. Maybe I'll go into the 1 minute time frame for trade execution, but ultimately it's between those 2 time frames for me. Big analysis, understanding my swing points, and then I'm pushing forward then with kind of me supply and demand zones and liquidity. But again, we're going to cover them in a separate video. So now that we've got our kind of main structure, we're just going to populate this with OB green to here, to here, and up to here. Now these are called the swing points. These are the low, the high, the low, and the high. But of course, within the swing range, we have the 15 minute internal range, right? Which again, we quite nicely just mark off with a highlighter tool again. I'm going to change the color to that. So bullish on the 15 minute, up to the swing point, then we come back down here. Then of course, we don't make a higher high. And so at this point, this is that trend reversal, right? And so I change at this point, this would be a different color. And that's the first point that we can signify that we're starting to see a change, right? So we can mark that again. That becomes our swing low. But because it's bullish on the 4 hour, that's why I have different colors. That's now signified still as a bullish move, but it's also now our new trend realignment, right? And I'm going to cover the breaks in a second, because this is where it kind of pieces together then. And then we flip bullish. Our job as traders is to capitalize on understanding the relativity of whatever that master time frame is. So in this case, if it's a 4 hour time frame and we're looking at the 15 minute for moves, we're trying to identify that point that we break here. And so what does that look like? Put simply, I'm going to show you this because I think it's an important tool to use. So whenever we get a break, right, which means we've pushed up, and then we've pulled back, and then we've broke this high, we always mark that down depending upon the 2 different time frames, right? So here, a bit of a glitch there. While doing that, we take the magnet tool off. A bit odd. Anyway, try again. Not sure why that's glitching there. Let me just see why that's doing that. It shouldn't be doing it. Is it a link? Maybe that's causing me the problem. Let me just try that again. Anyway, it's a 15-minute break, right? Don't know why that is doing that. That's just weird. Something causing me a problem down here. Why is that little jump? Anyway, you can imagine you'd have a line across there, right? Now that would be a 15-minute break. Okay, so I would, obviously this is market structure, right? And so you can call this term what you want. You can call it a break of structure, you can call it whatever you want. But for me, I like to identify it by its time frame. So I know clearly when I'm looking at the chart where that time frame break is. Now, for whatever reason, I would go to, that would be the candle or series of candles that broke this point here. And then this point, and again, we're going to cover this in the next video on the advanced section. This point here is the move that broke this high here, right? So just stick with me for now. This again would be here as another 15-minute break. And again, I don't know why that is not allowing me to do that, but anyway. Then of course, we get something a bit different, right? Because this is the first time this high didn't break this high. However, we don't know that this is just a small pullback before the move to the upside. So we can't mark this as a red swing point on the 15-minute until such time that either we break here or we break here. And obviously we break the low, right? And so we mark that on the chart as a 15-minute low. And I have mine different colors. Now, just as a quick pause, to set these up, you use the line tool. So if you press the shift key, it'll make it like whatever so it'll make it flat basically, so you're not trying to do it by eye. Double click on that. So the style, I just have mine dotted. You can have yours any way you want it. I have mine white, 100% on the opacity level. And then in the text, I just have, so I'll write 15M, and then I hit I'm on a Mac at the moment, but I hit the FN key and it brings up my different points. I just type in arrow and then I choose an arrow. Simple as that. It's an arrow down. So just to show you what I mean, double click, get my arrow. I have mine red, but I have different colors. If it's a swing, I'll have it a deeper red, like here. If it's on 15-minute, I'll have it that kind of lighter shade red. Same with the green. I'll have my swing points as a much more visually impressive green than the kind of faded greens for the internal swing. So again, just to double check, show you what I mean. So that would be 15-minute, hit the arrow key, okay. And then to save it, you're just gonna go template, save as, and then call that 15M. You obviously put the down arrow again, and then that will be saved in your templates. So my templates are, I just have 4. I have 4 hour up, 4 hour down, 15-minute up, and 15-minute down. The reason that's, for me, the way I trade and the way it's okay, it keeps things really simple. It's uncomplicated. I know if I break a key level, it's down. If it's a key level down, if I break a key level to the upside, it's going to be a key level up, right? And that's all I need to know to trade. Once we start bringing in liquidity concepts, once we start bringing in supply and demand, things completely change. But at least from a basic market structure understanding, it's the foundational layer for everything we need, right? So we can continue, yeah. Now, incidentally, that'll cause me problems. I don't know why that's doing that. 15-minute breakdown. Same again. 15-minute breakdown. I have to go over it for some reason. 15-minute. So break up, break down, break down, break down. Then of course we get a break to the upside, right? So what does that mean? Nice and easy. We call that a 15-minute up. And then this is the trend realignment, right? So when we know where we are relative to the 4-hour move, once we retrace deeply into this kind of zone here, well, at some point, this is what we call So when if we're trending bullish, right, this is a strong low, right? Strong low. And the reason it's strong is because it's done its job, right? Moves come up, whatever supply or whatever demands came in here has broke this higher level structure, which we're going to talk about in a second, but it's done its job. And so my thesis and the way I approach charts is once I'm familiar with the framework of the 4 hour, as in, are we bullish, are we bearish, are we trending? Once I know we're bullish, I will accept that strong low should hold. Eventually it will break, of course, all trends break, but you should go in with the confidence that trend line will hold, right? That low level of whatever created this low would hold. And so as the 15 minutes coming into this zone, you confidently know at some point that this should hold. Now, you're always going to get a little potential liquidity move and stuff like that. That's just part of trading. But at least from a framework perspective, we're anticipating that should hold. Of course, this here would be the weak high, right? That was the swing high previously, right? That was the swing range, which we call the weak high, right? And so we always anticipate, whenever we're doing the moves, to target on your trade the weak high, because we expect the weak high to break. Because think about it logically, if we're trending up and up and up and up and up, well then the strong should always hold and the weak should always break. Okay, so that's just the thesis. That's just how market structure is defined, specifically when we're trending. And so our edge is understanding exactly where that strong low is and having the confidence. The closer we come to that strong low, the higher likelihood that we're going to reverse and maintain the momentum to the upside or the downside, whatever the relative position is. And so what we actually get here now is a 4 hour break to the upside, right? So we can call that a 4 hour up break, and that I denote as a solid line. So again, on my charts, it becomes a lot more clear. The style, just so you know, is it's a line. I've gone with white again. Text is just 4H up or 4H down, okay? And so now that we've broke the high point, the new strong high is here, right? That is the level for the strong high. And then our new traded range is here. So this, my apologies, should be a strong low. And this is now a weak high. Again, we colored it red. So this is now a new traded range. So we're going to come back onto what our expectancies in terms of pullbacks, etc. But we can always anticipate now that the previous range, which was here and here, and our traded range is where's the draw tool here? This is our traded range, right? So price can do whatever it wants in this range, but we don't need to change anything on the swing points until such time that we get a break of either of those positions, right? If price maintains itself inside of here from a swing point or a 4 hour macro picture, we don't need to do anything else. We're just anticipating that it's just internal structure. And the 15 minute, again, this is why we use the 15 minutes to identify our internal range, can do whatever it wants. Again, when we cover supply and demand, and I guess PD, which is premium and discount, understanding where the ranges are expected to come into before we take a trade, that's when we'll start to kick into it. So let's move on. So we've obviously, the moment we broke that range there, we created a new range, right? And we're always going to take the new swing low, which is here. That's the lowest point of that chart, and the high there. Okay. So things are pretty straightforward so far. Hopefully everything is being followed. We'll just fill in the last couple of little points here just to make sure we are good to go. It's a 15 minute up. Let's go again. 15 minute up here. Again, I don't know why my mouse, the drawing tools is overhanging that, but that should just be in line with that line. So internal structure, as you say, just to recap, we've got small break, 15-minute up, a 15-minute up, then we make a 15-minute down, 15-minute down, another 15-minute down. We then make a 15-minute up, a new 15-minute up, and then of course a new 15-minute up until that target. Now on the 4-hour range, again, this is just bullish, yeah. So up, pull back, up. On the 15-minute, we go bullish, then we flip bearish, and then we flip bullish again. But we're only really anticipating this kind of pullback move when we get that first break from that downside. It doesn't always play out as perfect as this, but as a template and a way to kind of monitor and manage, this is what we're going to be looking for. So how do we, as a quick kind of teaser for what's to come, we need to understand the relative position, right, in terms of the swing range. And so whenever we get a move and a break to the upside, we should always anticipate a pullback back into this new range, right? And so if this new range was a Fibonacci move, right, I'm just going to highlight that. I'm going to change that to fair value, right? This is the discount range. So this is where we expect buyers to come back in when that sell-off occurs, and this is where, you know, it's expensive to buy, right? So we shouldn't be looking for buys in this zone, right? And so to create this, you can create it how you want, but the way I create it is I just have 3 points ticked on the chart. That was just the Fibonacci tool, right? I have 0, I have 0.5, and I have 1. Importantly, I have fibs based on log scale, so that because sometimes it skews it out a little bit, but that's just a perfect 50% range. So I'm always going to be looking at least for price to retrace back to that 50% or 0.5. And what I've always found, specifically on Bitcoin, for my back testing, is whenever I look at creating a kind of a potential pullback range, of course we've got all kinds of tools like the golden pocket where we expect price to come back into, etc, etc. But actually I found more value in my trades when I look for the reversal range, right, which is this range between 30%, 50% and 70%. Now, depending on what type of market it is, like when we get a huge big move to the upside, sometimes what you see is it may only come back into the 30% range before its next leg up. Sometimes it will come back into the 50%, which is what you should always at least anticipate doing. And sometimes even moreover, it can go beyond the 70% depending upon where that supply zone is on a long move, or a demand zone if it's kind of short and reversing back into the demand zone if it's a bearish price leg. So again, just to create your fair value range, 0.3, 0.5 and 0.7. You can color these whatever you want, but I always like to at least look for a retracement back into this kind of position here. So let me just mark that on the chart. So something like that, you know, into there, maybe even down as high as here before making its next leg up to the upside. And that's what you tend to see. I'm always trying to identify the pullback, right? So we know when we're in a bullish trend that the pullback is going to come somewhere into this range, maybe even more. Again, we'll finesse this a little bit when we look at liquidity concepts and supply and demand in session 4 or 5, or 4 and 5 actually. But for now, I just wanted to give you the main thesis on market structure. It doesn't have to be complex. What we're going to dive into the second course is how we apply this exactly on the candlesticks, right? So understanding how we use this same data to figure out where we are from a kind of a market structure perspective on the candles. So thank you for sticking with me. I'll see you guys in the next one. Bye for now.